Now on to our main event, and it is my pleasure and honor to introduce our moderator this morning, Paul Tilbury. So Paul is the Chief Operating Officer at the Dayhu Group, and he is also the former president, he is the past president of NAIOP Vancouver. So Paul, can I call you up to the stage? There you are. All right, turn it over to you.
Thanks, Paula. Our health and safety officer suggested I enter this side of the stage and avoid trying to navigate past all of the chairs and tripping over. So thank you for our health and safety approach to this morning's meeting. What a great time to be discussing industrial real estate here in Metro Vancouver. For many years, we would come to this breakfast and we'd ask ourselves, can vacancy go lower than 1%? Can lease rates continue to escalate? Is $800 a square foot for strata the new normal, and will it go higher? And are cap rates going below 3%? They were the fundamental questions we asked ourselves before we all patted ourselves on the back and said we've done a great job in industrial and life is rosy. But in the fear of alienating half of the room because of the demographic, I will quote Bob Dylan, and please, if you don't know who Bob Dylan is, I urge you to look it up. The times, they are a-changing, or are they? Here to explore this key question are four panelists this morning. I'd like to invite Ryan Kerr, Jaclyn O'Neill, Charlie Deeks, and Josh Gaglardi up to the stage. Their full bios have been in all of the material that we've put out, but I'll quickly, Ryan Kerr, for those of you, just do a wave, Ryan. Thank you. Ryan is Principal at Avison Young. Jaclyn O'Neill is Principal Investments and Portfolio Management at BentallGreenOak. Charlie Deeks, busy pouring water, is Chief Investment Officer at Pure Industrial. And Josh Gaglardi is President of Orion Construction. Before we dive into our panel discussion, I'm going to ask Ryan Kerr just to provide a little bit of an oversight on the industrial market here in Metro Vancouver. Thanks, Ryan.
No sweat, Paul. I don't know who's manning this, so I'm going to be giving some guidance to who's working the slide projector. Welcome, everybody, to the NAIOP Industrial Breakfast. I'm so excited to do this. I'm going to skip over the KPIs because I'm going to get into a little bit more detail on the entire market on each slide. So we're going to skip into page 2. All right. So to answer Paul's question, where are things going? I wanted to first touch on vacancy and size ranges and what's going on. I think if you get my email blasts or any of our email blasts from the brokerage community, you're going to see there's a lot more availability coming your way. And what size ranges are they coming? So going from a 30 to 50 basis point vacant market in 2022, when everybody's having a good time, wondering why they have listing agents, getting 9 no-subject lease offers, things have started to trend the other way. Probably for the best for your clients. If you're a landlord, you're not so happy about that. But where we're starting to see most pain is really in that 0 to 80,000 square foot range. There's very few standing options between 80,000 square feet and up. And really there's one big blue line on there. That building has been leased by Rolls-Royce in East Vancouver. This is Q2, so Q3 is going to get updated. Where things are going beyond this slide, though, things are going to change pretty quickly. So we are now at 1% vacant across Metro Vancouver. Q3, though, we think we're going to be around 1.6, 1.7% vacant. Some other numbers, depending on how you calculate sublease space and vacancy, they're going to be a bit higher. But really, availability is going to be at 4%. That's a pretty big shift. Some landlords might be scared, might be looking at exit options. Conveniently, I think that's just a return to normalcy. Things aren't overheated. It's like you can find space for your clients. So all in all, I think it's a fine thing. and I'm not that concerned about where things are going from here. Let's move on. So here is an overall slide on absorption, new vacancy, construction deliveries, as well as lease rates and where things are going. You know, in 2015, 2016, we started to see this all creep super downward. That was e-commerce, that was film, doing long deals. Ani did the old Wilkinson Steel Manufacturing Building in South Vancouver, 10-year film deal, record rates, type of building that would keep the market historically low in terms of rate. MBS, Sim, William F. White, they took big blocks of space. That was 2015. 2016, Amazon, Sean Ungama, his bank account's very familiar with that. Gateman Hot, they've taken, I think, around 4 million square feet in Vancouver, maybe more, plus some big sites for land and development. And we started to get into this landlord frenzy of good times. Paul had a pretty good time during that phase. Charlie bought South Fraser Distribution Center in 2017, and rates started to scream in 2018. His bonus started getting bigger. Josh started Orion Construction. Jaclyn started to kick out everybody of the BGO office in Vancouver. Good times were had. But what we're seeing now, I mean, coming on the heels of COVID, the growth in e-commerce continued with Amazon. Once again, Sean Ungama, super rich guy. Times are good. Rates started to creep into the low 20s. We get to our breakfast last year. So last year, let's go back to June 2022. First rate hike happened. The sky was falling, or so it seemed. People started dropping deals. I was at a wedding in London. Anthem dropped a deal because they got scared. But things didn't really happen as quickly as the doomsdayers really thought, and things started to kind of hum along. You know, the bid depth started to creep down, but at the peak, Pure Industrial in East Richmond had 14 offers on a lease space for 92,000 feet, $23.50 a foot, 4% bumps was the deal that got that, the group that won the deal. You know, that has started to decline downward, but there was a lot of groups on the sidelines that couldn't find facilities. So slowly that has been trickling down, and we're into today's environment, which there is a lot of sublease space. You know, there's a there's a screenwriter and actor strike in film. Manhattan Beach Studios has bought Vancouver Film Studios from the McLean family. You know, space is coming back, and tenants, occupiers, they're tightening their belts. So people get fearful. Landlords start chasing deals. But really what we're seeing in the market is very spotty activity. So yes, 0 to 80,000 feet, especially if go back to the vacancy slide. Don't actually go back to it. There's more space of small groups who are shutting up shop, transitioning to strata ownership, moving to Alberta or whatever you want to say, and decision making is getting deferred. However, if you've been on the sidelines and the right building pops up or the right land site pops up, the market's been good. So I know, and you're not supposed to talk about other people's deals, but I know of a lot of deals happening right now, very big deals, a lot of strategic deals, lots of land sites trading or under contract or firm at yesterday's high water mark. So really, I think many brokers in here, and I speak from a broker's background, so that's where I'm coming from, are going to have great years, but the rising tide has definitely is moving away from rising all the boats or whatever I misspoke. Feel free to make fun of me at any time. So it's not as frothy as it was. The multiple offers have calmed down. Vacancies coming back. But if you have a well-located building, or and we're going to talk about bifurcation of Class A to Class B, which I think is going to continue to be a trend moving forward. There's offers. There's offers flying back on everything. We have a number of land sites for sale. They're either under contract or under offer. There is demand, but it's just not across the board. That was very long. Can we move on? Great job. Okay, so I think everybody's aware with where rates have been going. We are now into an average asking rent of just under $22 a foot. I checked in on our Q3 numbers. This actually has gone up 3 cents a foot. I think all of the landlord community, especially the ones in this room, want to stabilize it where market was. And I think, based on all the offers that I'm seeing, I'm not seeing this drive down unless you're on maybe a Class B building, more manufacturing oriented, something that there's optionality for tenants that previously there wasn't. You might see the landlords start chasing deals, but for the most part, I've seen rates hover about the same. Next slide. So just as it relates to what's under construction in Metro Vancouver, we got 7.1 million square feet. So much of that's actually been pre-leased. I'm not supposed to talk about other deals again, but a very large women's clothing company has done a very large deal in Delta. A very large pet food distribution company, Paul, has done a deal in Campbell Heights. There's some really good name brand companies doing very large deals, and there's just not that much space coming to the market. What is coming is infill development and strata opportunities in that 0 to 10,000 square foot range, so where you might see some softening in rate. But so many of these tenants are also getting hit with giant renewal proposals, are looking around at market options, and are transitioning to strata ownership. The strata market is still alive. Hallelujah. And we're seeing deals across all the projects, the ones we track, the ones we're selling, and it's almost exclusively user-driven. And yes, Paul, they're still trading at over $800 a foot. Market's on fire. But no, that market has been active, and I think kind of the overarching thing that should keep everybody comfortable in here is that our land supply has not afforded us to go too crazy in terms of overbuilding. So I don't know if anybody, this is a pretty white collar room. I'm sure you've all been a golf cart before. Well, if you start going downhill in a golf cart, something kicks in to slow you down to go out of control. And our land supply and our inability to spec build has really prevented us from going, turning sideways and getting a pretty dicey accident. And I think that's kind of where we're at today. We just don't have the space to really shoot up our vacancy that much and have the bloodshed that the reporters in this room who got me in trouble last year would love to have me say something incendiary. But I think it's a bit of a return to normalcy is what we're seeing in the future. I think that's it.
So, ladies and gentlemen, thank you very much for coming. Ryan says everything's great. Have a wonderful day. Jonathan Barnett, who I work with, shout out to John because he likes a shout out, tells the old fable. Ask a man how he's doing in 1 word, he'll say good. Ask a man how he's doing in 3 words, not so good. So let's peel back Ryan's look at this market. I think one of the most pressing questions that is probably sitting with the audience today, and certainly with myself based on what I'm seeing in the business, is lease rates. And in your opinion, Jaclyn, are lease rates softening?
Softening. Such a scary word. I think what has happened in the industrial market over the past year in particular is we've all become addicts to, something extreme. It's either skyrocketing or it's going to plummet. And I think part of that is coming from, what we're seeing in other sectors. Certainly in the office market, there's a lot more trepidation about what the future holds with, as you have the slow roll of office tenants kind of reevaluating their needs. I think what we're seeing is not so much a softening in the industrial market, but to Ryan's words there, a return to normalcy, maybe a return to sanity, a world where both landlords and tenants can plan ahead and actually perhaps know, what the terms of a deal are going to be. So, to say it's softening, I think we're all, have gotten into this 24-hour news cycle in the industrial market where rates are changing month to month, week to week, multiple offers, and honestly, sometimes it certainly did feel like the sky was the limit. There's certainly a check on that in the market, and I think it certainly is, due to the headwinds in the economy right now. But what we need to remember is I do think that the long-term tailwinds of industrial space are still there that are going to carry this through. So while there's maybe a bit of a sanity check going on right now and a return to normalcy, I certainly don't think that I would characterize it as a softening market.
And Charlie, you're in from Toronto, so you bring a little bit of a different perspective from central Canada, or back east, as we like to call it out here. What's the prognosis from your perspective? Are lease rates, and I'll use the same word, softening, or are you going to call it a return to normalcy? And maybe check in as well for us on, I think there was some giddiness in our industry about 4 or 5% annual increases. Still a reality?
I mean, no doubt that there's softening, but you're also seeing face rates increase. Still in Vancouver, I think it went from 20 to 22. So imagine it went from $6 to $8. That's back to 35%. Back to Vancouver's 17%. I think it was 35% last year. So yes, it's down, but in any year before COVID, you would take that. So, Jaclyn, you mentioned tailwinds. I think a huge tailwind for our industry. Industrial is the goods business, office is human capital, and retail is just an outlet for goods that come through our spaces. And population growth, Canada, I think this year is going to add 465 new Canadians from immigration. 15% are going to come to BC. So I think that bodes very well for especially small bay real estate, people that are looking to establish companies, really get their businesses started. What keeps us up at night? We're still seeing growth. I think inflation on our market, rent curve inflation, where we were kind of assuming in our performance 8-10% a year, we're probably closer to 5%, but you're 5% on $20 starting. So you have to be careful where your rents really climb to. Fair enough. 10 years ago, do we think rents would be $22? Not in our wildest dreams. But what concerns me a little bit is, especially in our market, and probably out here too, is developers that have been sitting on really high, that have bought land the last 2 or 3 years, sitting on really high bases. Construction costs have increased, financing costs has increased. So for the large bay sector, we're just weary of anyone kind of panicking and doing a below market lease rate, because that would have major implications across our industry. So a lot of people are sitting and waiting, but let's just hope it doesn't come to that.
And are you prepared to put a number on what you believe is that threshold of below market lease rate? 200,000 square foot brand new build, by way of example.
Are we talking in Ontario or here?
I'm talking here in BC, Lower Mainland, Metro.
I mean, it's funny, we're pretty close to you guys. We're $20, you guys are 22. So, 5 years ago it was a different story, but I don't know, something like a 16 or 17, I think. What's that, 10-15% below? I think that would have a lot of eyes on that.
That's a terrible idea.
We're not doing that, Ryan, and don't do one either.
Yeah, we'll explore, we'll explore the development side a little later on in our conversation, because, you start getting to $16, $18 lease rates. It has a profound impact on a pro forma. Ryan, I wanted to ask you, kind of, as you break down a segment of tenancies, you say there's some transactions. Is there a group that is active? Is there a group that's not active? Somebody had explained to me quite passionately in the 3PL business that there's a number of groups in that particular segment who are coming off some old lease rates. And if they still have old lease rates with 2-3 years left to run, they have a critical advantage over groups who are facing today's market lease rate, because contracts turn on 2-3 year timeline. Are you seeing that? What's happening in the 3PL segment? Is that a group at risk in our market?
Yeah, good question. Wasn't prepared for it.
Shouldn't be.
Specifically 18 wheels on that one project you mentioned?
Let's take that out of the discussion. I think that's been a huge benefit for any of the 3PL companies who have historical lease rates, especially if you're doing a 3-year renewal or a 3-year contract with the actual occupier or whatever you want to call them. So that is a massive benefit. Or, I mean, if these groups own their buildings and didn't have to ride with the fluctuations of the market, they would. Conveniently, they don't really own much space. But I think that's also why so many landlords, I mean, this group included, were able to transition from 3PL tenants to the direct tenant during the rise in where the market was going. With a bit of softening, I think you're going to see more 3PLs, and I know they're out there because I'm seeing paper from them. They're back to the game. This is when they try to capitalize on a softened lease rate. They try to get Charlie, a little bit drunk later and take advantage of a $16, $17 rate. And then they're able to secure contracts again, and they're going to be back in the market. I think they're back now, and I think they're going to be back for a bit. And that's just a function of a softer market.
And you'd touched on film users, obviously a little bit of a shift, and we're seeing it in our portfolio, as you lovingly phoned me to tell me, sublease opportunity. Is that, even with the writers' strike being resolved, apparently subject to votes, is that a market that's going to thrive a long time here? Are you seeing that demand still?
Good question. Okay, so Larco bought Golden Boy Foods in Lake City. They've done a deal in Central Burnaby, which they're going to do another purpose-built film. Larco owns Bridge Studios, the Lalji family. They own the hotel we're in, and they're going to build a purpose-built facility in Lake City. They're going to build one in Central Burnaby. They bought the city of Burnaby lands in South Burnaby, which is 16 or 17 acres. They're going to build what a film occupier or production company really wants, which is about a 45,000 square foot shell. And it's going to be soundproof, and then it's kind of like what you see on TV in LA. And where we talked about 2015, those film groups were looking at Wilkinson Steel, an old steel shed, the Weatherhaven building in South Burnaby, Crossing Studios did all these deals in Burnaby. These were making it work in industrial buildings, and they're going to gravitate towards to the purpose-built facilities, and also Manhattan Beach buying Vancouver Film Studios, where they've got all this out-of-house production, which is why you're going to have why you have a sublease opportunity. They're going to bring that into production-oriented space or purpose-built production-oriented space. So I think you're going to see more softening, but I'm sure, I don't know about everybody in the room, I'm done with Netflix. I'm like watching hot garbage reality TV now because I've seen everything. So I think we're going to need some production again in the near future.
Yeah, well, what you watch at night is your own business, my friend. Josh, welcome to the conversation. On that segue, what are you seeing from a construction side? And we'll deal with costs a little bit later, but what are you seeing as kind of key must-haves now in buildings? Is anything changed, or are people still kind of contemplating building kind of the same type of product?
Yeah, I'd say people are elevating their game in what they want to build in construction. So for new build, all our new generation of projects are coming out with higher clear heights. What was traditionally 26 is now minimum 32, maybe even 40. So we're seeing that across the board. On the sort of existing product renovation side, we do get approached a lot by clients who want to, maybe take an old building that's not getting a very good lease rate, maybe dress it up a little bit, paint it, and lift the roof, see if they can get a more market appealing clear height in the building, maybe upgrade the sprinklers to an ESFR system. Those costs, though, when they come through, they always ask for a proposal and want to talk about it, very interested. But when the costs come through, I don't think it justifies the value add for them. I don't think the lease rate will cover up those costs.
Let me jump on one piece of that. Lifting roofs.
Yeah.
Is that easy? I mean, I hear about it. I've never seen an example.
I think if it was easy, we'd be doing it a lot.
Yeah.
It's possible, for sure.
Yeah.
But in this seismic zone, it's really, really complicated. So I just don't think that, I think more likely those old buildings are going to continue to be old buildings and demand a lower lease rate. And in enough time, they'll be redeveloped for a higher, better use rather than the lipstick.
Yeah, a little bit of lipstick and away we go. Yeah. Charlie, how are you speccing out new buildings? What are you putting into base design that perhaps you weren't a few years ago?
Yeah, I mean, clear height for sure. I would say in our markets, 36-foot clear is definitely the norm. We've got a 4 million square foot $1 billion development pipeline, and pretty much we're doing kind of carbon zero or carbon zero ready. We've kind of made that decision, or we're definitely looking at it. So, what that involves is electrification of buildings, moving away from natural gas, EV charging, rainwater collection. Like the technologies are incredible. We have a sustainability team of 5 or 6 people at Pure. We didn't, that wasn't even in the cards 2 years ago. So, it's more expensive to build for sure. I would say it's anywhere from kind of $13 to $23, depending on the scope. Josh, you can correct me if I'm wrong. What that translates to kind of get the same return is another $1 or $2 more in rents that you need. Are we seeing, this might be your next question, but I think tenants will eventually, I think they will pay for it, especially tenants with big multinational footprints. And we want to make sure that if we're building new today, we want to have a building that's future-proof for the future. Most of our product, we have 410 buildings. The average age is 35 years old. So it's more expensive on the older stuff, but the newer stuff, you'd be foolish if you didn't look at that.
Just on the tenant side, we're starting to see the checklist of what we can deliver from an ESG or LEED or whatever standard each individual occupier is looking for. And you can see it's top of mind, and then, ultimately it's Vancouver, that's what's available, but we're starting to see that trickle into our market, which I think in Ontario, the checklist is real, competing for tenancy based on ESG scores or LEED or whatever. It's way more top of mind.
But it's definitely coming here.
100%.
Yeah. We're fielding more inquiries now than we ever have on it. Our research indicates that I don't think there's been a single net zero industrial building built in the Lower Mainland or BC yet. We've got one starting construction for a federally mandated national tenant in the spring of 24, so that'll be the first one that we know of. And then with Jaclyn, we've actually got quite a few on the go over the next few years in Surrey. But the costs are real, and someone's got to pay for those costs because, like you said, our costs are generally anywhere between 8 to 20% more. But I think the real value of net zero is going to be identifying the existing portfolios and upgrading those portfolios. And that's a program we're putting together as an organization right now to target, older buildings and get them up to this next standard of design.
Why bother? It's to be a contrarian. We've got vacancy 4%. Some would argue that a normal market is 6%. Why bother?
Because the governments make the rules.
And institutions also have checklists on what they're buying. So for liquidity, if you're Jaclyn and wanting to eventually vend said assets, it's going to be much easier for them to be liquidated.
Jaclyn?
I think with the run-up in land values and construction costs, yes, it is a real line item, but when you're spending hundreds of millions of dollars on a development, to do that and not think of it being a relevant building in 25, 35 years is incredibly short-sighted. We're building for, long-term core assets of scale, and we have our internal targets for 2030 energy intensity reductions, and then 2050. Well, sites that we have right now, those buildings are hopefully going to be around and relevant in 2050 if you're spending that money. So for us to just be focused on, the snapshot today in terms of, well, can I get that extra 50 cents? Is, I think, quite short-sighted. We're also wanting to attract, I think you touched on it, those covenant tenants for these assets, those multinationals, those cold storage groups, and they demand it. So not only are we're hearing these questions from our investors, we're also hearing it from, the top tier industrial tenants that we want to attract into our portfolios. So it's, we're planning for the long term over the life cycle of the asset and wanting to have those tenants. So it's very much like table stakes now for any new development.
So it means you're upgrading structures on roofs, you're to prepare for solar. Gas is a thing of the past. So, are people doing that? You're moving away from kind of gas-fired rooftop units. Are these all things that people are purposefully working through as they go through their CapEx programs? And if you're saying it's 15, 20% more on the cost side, on your hard costs on a base of
All the 110.
110, on a basis of 90. On a base of 110, it's it's an extra $20, so that's an extra $250 a square foot. That's difficult to get your head around if you've not got deep pockets and a long-term vision. So, does that marginalize some people in our industry, perhaps? And I throw that question out generally.
Yeah, well, it does. Everything just gets more expensive for the consumer, right? And then the tenant.
And what does that do for a tenancy? Is that going to continue to push vacancies? Is it going to push people out? We've NAIOP just co-authored a report with GVBOT, the Board of Trade. 5.5 million square feet over the last 4 years has migrated up to Calgary, really driven by the unavailability of land space. But Alberta has a different perspective when it comes to carbon fuels than perhaps British Columbia.
And making money.
And making money and taxes, but it's a long list. Let's not go down that rabbit hole. Is that just a further challenge to the competitiveness of the British Columbia market, Jack?
I think you kind of got me thinking there a little bit, and it might, end up somewhat bifurcating the market. I mean, as we look at our portfolios and plotting out to net zero, there may be some assets where it doesn't make sense. And, I could see other owners kind of coming in to fill that gap. And so you may have, the world that perhaps institutions are increasingly playing in, which is, where you have the scale, the newer quality, the net zero carbon, attracting certain tenants. But that doesn't mean that there's not going to still be a market for tenants that maybe don't demand that, don't need the same ceiling height that, and you have private owners or different groups that are happy to kind of take that position. I do think, all groups are going to have to be cognizant of climate change and planning for their portfolio and what that's going to mean for their buildings and operating their buildings. So you're not going to be able to dodge some of these things forever in terms of like insulation in the roofs and your power sources. But, it might not be, it's not going to be the same standard across the board, I don't think.
And are we starting to see that, Ryan, you'd talked on the leasing side. Are we starting to see the segmentation again between A's, B's, and C's? There was a time that if you had vacancy, somebody was going to take it regardless. And you almost had a bit of a mismatch with some of the multinational tenants going into properties that you kind of perhaps didn't necessarily, I don't want to say align with the brand, but you kind of almost surprising, but it was the only thing available in the market. Are we starting to see that segmentation?
I think we're going to see more of it. I leased a building on Annacis Island that had like wood ceilings and no sprinklers, and it was 18-foot clear for $22 a foot. Maxed out the yard, which wasn't really a yard.
Obviously not one of your listings then.
No, it was my listing because I'm a good listing agent. And I think in a tougher market that might not do so well. Where I think, yes, to answer your question, I think you're going to see there's a way to calculate cubic volumes of space. So there's actually you don't just talk about ceiling heights. There's more space in a building that's taller, right? So you should be able to command more rent with more cubic volume, more efficient column spacing, blah blah blah. That's definitely going to happen and I think you're going to see that. But when it also comes down to bifurcation of rents, it's how uniform your product is. Where's your building located? Like if you were still in an A location, I think you're going to see less of a bifurcation or a differential in rate or a drawing down of rate, because there's only so many buildings in so many places, and there's still so many tenants that have sat on the sidelines going, I would like to lease a building or buy a building in this location, and everybody might look at the headline and say, oh, I can get it for a better deal. Well, if it's available today and you can lease it today or you can buy it today, and we're seeing these deals happen, we talk about all the deals that are happening, it's those groups who've just been waiting, and it's the right opportunity, and they're still willing to pay for it.
I think during COVID, it was such a arms race to get just a piece of concrete to put a pallet on. It didn't matter, I'm being a little bit, exaggerating a bit, but tenants were definitely making compromises. because there was nothing available. Now, where they start seeing some new supply come up, they're starting, to maybe we can maximize the space. Like I was shocked walking through a 32, 36-foot warehouse with a company that was just stacking heavy pallets on top of each other. They wanted a rack, they couldn't get the steel in time. So, but now they have that lease, and now they can, be more functional. So, I think they're waiting with bated breath on renewals. I think every tenant out there feels like they can get a better deal. It's not so much, is it 19, 20, 21? It's like, do we need this space right now? What do our growth prospects look like? But just on to the building attribute side, the number one thing that in our market that is still a concern is access to labor, to cheaper labor. Not only labor cheaper like rate-wise, but also just actually getting bodies. I was driving the other day and listening in Toronto, it's 640 or 680 News, and in a span of an hour, I heard 3 advertisements on the radio for job fairs. One for Uline, one for, I think, Amazon, one for another company. But, competitive wages, $75K a year, benefits, bonus. That's pretty compelling. So anyway, it's, I think, core located markets like, Richmond here, Burnaby, Brampton, Mississauga in Toronto. I think that's still the biggest driver on where tenants want to be rather than face rates.
Yeah, proximity to the workforce, right? Which is, and obviously at NAIOP here, we're doing some work on transportation and transit, which is a bit of a challenge. A quick question just to the panel, and then I'm going to come back to you, Josh. We talk about cubic capacity and heights. Anybody seen any lease deals which are based on cubic capacity? Cents per cube?
No. But I think it comes into the equation when you're willing to pay top rate.
But are you seeing a differentiation on rates between these buildings which are 28-foot clear and ones which are 40?
Not yet, but I think just back to our previous comment, I think that is definitely going to weigh into, if you have option A in the same location as option B, I think it's going to command a different rate based on cubic capacity.
Josh, I want to spend a little bit of time just talking about construction costs. We all understand, well, we don't understand, but we see what's happening with interest rates. We understand inflation is happening. What's happening in your world in construction costs? And I know you put together a couple of slides just to demonstrate it, which is hopefully the cue for the AV people to put that up.
So I've got some very simple slides because it can be very complicated with what's going on in the construction landscape these days. Eventually they'll come up board. So what we've got here is just an aggregate of all the projects we built in each year, indiscriminate of small bay, large bay distribution, and net of any external costs like site servicing and offsite works and preloads. So this is just sort of your baseline hard costs over the last 5 years. So you can see quite a dramatic increase. If this were a more granular graph, you would see that it actually has come down in the last 6 to 8 months. It's fallen off from the peak, about 5 to 7%, but we're nowhere near where we were 5 years ago, and we're no longer going to be anywhere near that. So this is the new normal. This province is incredibly busy just with capital infrastructure projects, let alone what the private citizens of it are doing in real estate. So I don't expect major increases over the next 12 to 24 months, but I don't expect any major decreases either. I think we're sort of hitting a bit of a stable new normal for construction costs, and I'm hoping maybe we see maybe a bit of a reprieve to 5 to 10%. If you go to the next slide, it just shows this in terms of cumulative cost. So, from 2019 to 2023, hard costs are up 35%, which is a massive number. Anecdotally, I built a beautiful building for our friend Charlie over there in 2019, and he loved me. He'd call me all the time. And now I don't hear from him anymore.
I miss you, Josh. Let's build another one. I miss you too,
Charlie. So it's tough out there with construction costs, and layering on top of that is, financing costs have doubled, and basically across the board, municipal DCC costs have doubled, and Metrovans rolling out, more of a tripling of their costs over the next 2-3 years. So There's just a lot of headwinds working against development right now, and no real areas where you can see any sort of reprieve, except for maybe land price, but that's not happening anytime soon.
I think that's a good thing to jump in on about headwinds for development. I mean, we talk about fear and vacancy going up and landlords not being able to get what they want of deals. Land financing is 8 to 9% based on a land loan of my client they got last week. Same for construction financing rates. We've got some big user deals that are kind of backfilling on some land sites that are at yesterday's number. So you're still in the $7, $8, $9 million an acre range. So you're not going to see a big wave of new developments that are planned and coming that don't have a historical land base, which is only going to, vacancy's going up, but I definitely see the other side of that in who knows how long, but we're going to be back to the same place. We are still land constrained.
Yeah, Josh, just coming back on construction, $167, $65 a square foot. Just to define, that's hard cost.
That's hard cost.
So what do you get for that? You
get
just
a
get
box.
the base building. You get a box,
You get
right?
a box with some
Still got to
landscaping.
finance it. You got to find a piece of land.
Yeah.
You got to pay your DCCs.
Yeah, this is a very
Not
simple
much.
box you're getting.
Right, you've got to pay interest. You've got carry. You've got TIs. You've got commissions.
Yeah.
Right, you've got all of those things. Some of which you're obliged to pay. Some which you can negotiate on. So Charlie, can you develop in British Columbia right now?
It's been very hard for groups like us who are build to lease to make sense of numbers in Vancouver. Actually, our first development we did was Ryan sold it to us. We thought he was inflating the books, but we bought it well, and we had Josh build for us. That was our first development, and that did very, very well for us. But it's when you're buying land at $5 to $6 million per acre. Look, pro formas are under pressure right now. You have the cost of land in Vancouver, which for some reason always seems to go up, or just is not moving. You've got decreasing rental rate growth. You've got increasing hard costs and financing costs. But also for developers, IRR-based developers such as ourselves, you have what's that building worth in 3-4 years? And, exit cap rates, terminal cap rates are probably up 100, 150 basis points. So when everything's working against you, and so you have that, but it's also, I think a lot of groups now are sitting saying, we can go build, but I think there's better risk-adjusted returns out there. I think if we wait, we could probably pick up some higher quality buildings, versus having to, do this ourselves. I don't think there's enough of a risk-adjusted premium, especially in this province, to build.
So what number do you need to see as a return before you feel comfortable taking it to your investment board?
That's very private information.
Understood.
But I would say it is 150 to 200 basis points probably higher than it was when we did our deal a couple years ago. So.
And what was it?
Oh my gosh, this wasn't it. We didn't talk
Jaclyn,
about this.
I'll come over to you while Charlie decides whether he's declaring it, whether you're sharing that. What's your outlook on development? Your group develops?
I mean, we certainly have a development pipeline that we're working through our entitlement piece on right now. If that was shovel ready to go today, would we, be pressing the go button? I think we're like many institutions, similar to what Charlie said, fairly capital constrained in terms of taking on new projects at this point in time. We've been, certainly we have some sites in Alberta that are more ready to go, and it's the same story as it is out here. And I just to tie it back to our rental rates softening, that the construction costs and the interest costs right now are, I think going to buffer, any new supply from coming into market in a material way, which is just going to be added pressure to at least maintain where rates are right now. If we're looking at, what do you need in terms of a return when you can get a risk-free return with a GIC at 5%, and then you're hearing all these, construction costs are moderating and all these things, risks are ebbing, there's still risks associated with it, and being able to secure those tenants. So, where we would have maybe been a 4.5 for development in the past.
Looking at me.
Now I think you're certainly north of 6. And it's really, to just add to Charlie's point, it's Well, we're fortunate enough to have an excellent industrial footprint already within our portfolios. So we don't need to expand into that. We're planning for the long term, and in fact, we've actually been strategically selling some of our industrial assets across the country. But you look at what it's not just real estate, but what you could maybe get as a return in in the other food groups, investment food groups, and needing to build up our other core holdings. Most notably for us, I think certainly a big focus on multifamily.
Josh, one of the things I've seen in the United States is when people are speccing a base build, it truly is a box, right? It's as stripped down as possible and everything gets pushed into the TI side. Are people looking at that and just going, I'm not putting docks in, I'm not putting levelers in, I've got a single light bulb hanging there. Everything goes to the TI side, and if I can get in as least expensively as possible, I'm not going to overbuild this building for tenant number one. Are you seeing that at all?
Not really. I think the standard specification we have in this market is a pretty reasonable warm shell specification. Some groups do develop out their concept a little bit more and put in offices and bathrooms. I don't know if they get the full utility of that. I don't know, they'd have to go through all the purchasers and see how many of those purchasers or lessees actually effectively wanted that or used that because they're forced to pay for it. I don't see that changing very much. I think our warm shell spec is pretty good spec, and it leaves the versatility on the tenant. And oftentimes, those tenants can build them for cheaper than the developer can, right?
I'd like to counter that, though. Josh builds premium product. So the shell got cold during 2021, 2022. You want a heater? You want a bathroom? You want lights? Some people got away with doing without those things. But I think the return to a warmer delivery is coming back.
Yeah, Charlie, let me ask Charlie this question. In terms of site coverage, we did a survey, NAIOP did a survey as well, co-authored with the BD group, just on the amount of parking required in industrial landscape. Bigger site coverage, is that called for? Is that a trend and maybe a way that offsets the underlying land costs and tries to bring your pro forma in line?
100%. I would say, if you're building a building today, you don't want to go much higher than 42, 43% site coverage. The demand for trailer storage in our market from tenants is extremely high. I think tenants think it's probably cheaper to store in a trailer than in a warehouse where you're paying $20 for. The problem we face, though, is zoning from most municipalities in Ontario, probably BC. I mean, no one wants trailers parked. No one wants to see sea cans stacked. So sites that it's funny. I would say for people that need low site coverage sites with trailer parking, they'll pay up. Where another tenant will just, that's too much, it's not important to them. So trailer parking, yes. Employee parking for sure. And, good functionality. You don't want to mix trucks and cars. If you have lit intersections, like all these, little things that you go through and you learn talking to your architects, there's much more to just the box than the building itself, so.
Okay.
Yeah.
Jaclyn, you talked about developing north of 6. Charlie talked about 100, 150 basis points over to validate. So that puts cap rates high 4s, maybe low 5s. Where are cap rates?
That was to you.
That was to me. Well, we've been fortunate in our recent dispositions in the market to, outperform where you might where you might see a stabilized cap rate. I think, from an institutional perspective, what do we think a stabilized cap rate is today? Well, we'd like to see it getting to over a 5, quite frankly, but realistically, we're probably starting at a 4.75. I think some groups have different metrics, need space, or are more bullish in terms of rollover, and are willing to stretch, because I think what they see is these assets you couldn't get a year ago, 2 years ago. So where it doesn't maybe hit the institutional, where we already have a footprint, BC, I think, still has a bit of cachet of groups wanting to get into this market, needing to get exposure to this market, or potentially owner users who are just so jaded about getting, outbid on other lease offerings that if they're seeing something come up that normally wouldn't come up, and it was institutionally managed, they certainly seem to be, seeing the value in that, and so we've been pleasantly surprised. I would say, in BC, I wouldn't say that that's across the country. Certainly, Alberta is more back to real estate fundamentals, I think, in terms of, value add, core plus buyers seeking a return, and that being the primary driver of value today. But, the BC cachet, I think, still holds a bit of a value premium in today's market. Particularly, I would say, I'd put a caveat to that. I would say in a market where you can get competition from owner users, privates, and maybe some institutions, the higher you go up, the deal size, I would say you certainly will see a bit of a thinning of the bid pool.
Mm-hmm. Charlie, I'd like to, so 475 normalized, take that to the bank. Charlie, I'd like to, maybe good enough just to kind of peel back the secret sauce. So in today's market, where you've got lease rates which are trailing kind of normal, so you may be looking at an asset that's got $15 lease rates, but the market's 22. How do you value that? What kind of time horizon do you look at to get to normalcy? And how does that slide in terms of a cap rate? And happy to throw interest rates in that mix as well, because it's much more prevalent as a deal metric today than it was 3 years ago.
Well, just on cap rates, it's funny. We've started to see a phenomenon. Here we are in 2023. I would say lease rates really started to do their run in 2018. So we're now seeing some assets come to market that have, the days of the $6, $8 rents, 2.5 caps, those days are done. Unless, the lease is rolling over next year. So we're starting to see some pretty good out-of-the-box yields. We're starting to see, there's a pretty big deal in Toronto that just cracked, was just below 5, but that was on $16 rents. So, but it's not a ton of growth in that cash flow. So you're able to get higher yields, but as a result, even at a 5 cap, like your basis per foot, you're up at replacement cost anyway. So there's always a bit of a trade-off. Stuff that is, look, if it's kind of 3 to 4 year wall max remaining lease, you're able to get a decent cash-on-cash return, not to be cash negative the first 4 years, where, when you're borrowing at 2.5%, it was okay to that was a little bit easier discussion. That stuff is still trading very strongly. I think the larger the deal with longer lease terms with limited annual escalations, those ones are very hard to trade. There's not a lot of core capital out there right now to really bid that stuff up. It will move, but not at, people need to make money in this business, and when you're borrowing at 6.5%, 7%, you can only take it on the chin for so many years before you're hoping that rents increase. So,
yeah, it's an interesting period to even look at transactions which are cash negative, but just bank on it. Are you factoring in interest rate in your underwriting? And if so, where are you pegging that 24 months?
We certainly are. Look, I think, just from a Fed level, from a government in Canada, I think we have definitely one more increase this year, maybe another early next year. We're at 5. UK just held at 5.25. US is at 5.25, so we got to kind of keep up with the Joneses a bit. But until inflation gets 4%, well, it's 4% unless it gets down to target, which I don't think that's happening anytime soon. So we are certainly affected our pro formas. Obviously, the relationships we have with the bank are key right now, but things look a lot different than they did a couple years ago.
Okay. Just want to touch on the strata market. Ryan, you said it was alive and well.
Deals are happening.
How many though?
People.
Lots.
gentleman debate. Are people buying to build? Are people coming out of the ground? Are people looking, Josh, at taking their strata plan and converting to hold that for rental income?
I'd say in the Fraser Valley, strata is definitely slow. And
Don't disagree.
There's definitely a couple instances where people have transitioned from strata to lease, and the building doesn't need to change that much to do that. They're designed pretty versatilely, so that's not that big of a deal. But if you're buying that property for strata and you're forced to lease it, your financial metrics probably aren't looking that good. I've seen the Langley, Surrey, Avison markets be incredibly slow on strata these days. Ben sat up here last year and talked about how there was no bid and referenced a project of his, Latitude, that had only one unit under contract at the time. And, a year has passed.
Ben's in the room.
And it's still not sold out, I believe, Ben. And all that's really changed in the last year is that interest rates have continued to go up. So maybe there are owners needing to have space, and there are purchases of Stradians, but I definitely don't think that that's a strong market right now.
Ryan, as a rationale on a buyer right now, I'd rather pay an interest rate because I know it's a variable cost as opposed to go into leasing, which ever seems to escalate.
I think that's part of it. Just where things are softest is how much supply is there to compete with. It's not too dissimilar from the leasing market. So in locations where there's not been a new project of a certain spec, we're still seeing sales. PC Urban's project in Coquitlam, they've got, I think, 5 new deals there. South Van, we have 2 deals done and 5 under contract. That's just 2 examples. There are deals getting done, but if you're in a location with a whole bunch of supply, there's less bid. People can be selective. They're not moving as quickly. But I think that just the logic of what you're saying, it's end users, yes, they're getting big renewal proposals. They're tired of not managing their costs. And a lot of these people are private, high net worth people who like to control their destiny. And I think those are also the same people. Jaclyn talked about a process that they had. It was really an investment deal. End user came in, paid north of $500 a foot. There are users who've been on the sidelines losing bids to sophisticated companies with great relationships with brokers, and they lose and lose and lose. And if you ever tell a rich person that they can't buy whatever they want, you get really pissed off. And I can tell you those people are still thinking long-term beyond, a bit of a soft market, and their business still can sustain what they want. And those are many of the deals that I've been kind of dancing around. There's a lot of private money still wanting to own, whether it's for their own use or to invest, and are thinking beyond the cycle.
Okay. It's fascinating. We could go on and on, but 2 years ago, everybody would have been itching to get out of here because they had flights to catch somewhere sunny and golf to go and play. Now everybody's itching because we've got to go back to work and roll the sleeves up and get it done. It's a bit of a shift on our industry, and that's not unhealthy. Let's quickly wrap this across the board. It's prediction time, but really quick fire. I'll start with you, Charlie. What are we going to be talking about positively next year, and what are we going to be talking about negatively next year in industrial real estate?
Positively, rates will continue to increase, but at a lower pace. Negatively, interest rates. Interest rates still feeling their effects across.
Coming off next year?
Probably mid to end of next year, I think you're going to start seeing it maybe tweak down a bit. But we got to see the inflation come back.
Ryan?
You're going to see lots of user activity to backfill investor demand that has to make sense of cash on cash and blah, 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 whatever Charlie was saying. I'm just kidding.
We don't do finance out here normally.
I'm kidding. I've got an analyst. He's very smart. I'm just kidding, but there's a lot of user activity that's in the works that I'm aware of, whether we're working on it or our competitors, and those deals are, many of which are already firm, a number of which are under contract. You're going to see those deals happen. I do think you're going to see some landlords chase down rate when they're a bit concerned about sitting on vacancy. Not everybody is, Sun Life or Blackstone, bankroll. So you're going to see some chasing down of kind of the B space in terms of rate. But I think if you have a well-located asset or a tier 1 asset, I think the rates are going to remain relatively flat, like the same. Market's good.
I think we're going to see, the effects of the interest rates continue to play out, likely, to the downside over the next year. I think it's going to be, there's going to be some challenges, but I do think when we look back, we're going to see, industrial as an asset class, while it may have taken some hits here and there, is going to be very resilient relative to the other asset classes. So I think that is going to be, the story. And, with some surprises here and there of owner users and groups, taking positions and viewing it as their window, because I do think if, this does have the makings of a window for groups that have historically been priced out.
Yeah, positively, I do see that there are still groups that need to proceed, users, businesses. So they're going to float this market for the next 12 to 16 months. I think construction costs are pretty flat and are going to start making their way down. And I see that on the negative side, we're going to have a major issue in this province with skilled labor. It's already an acute issue. It's just growing and growing every year. The workforce isn't coming up to replace the one that's retiring. And that's going to be felt in all industries.
Yeah, Calgary's getting the benefit of that with multifamily as well. Like you see what's going on.
Josh, Jaclyn, Ryan, Charlie, thank you very much. Really appreciate your insights this morning. Ladies and gentlemen, our panel.
And a huge thank you to our moderator, Paul Tilbury. You always do a wonderful job. And again, thank you. And thank you to our esteemed panel. We've got Charlie Deeks from Pure Industrial. Thanks for joining us from Toronto. Ryan Kerr from Avison Young. Jaclyn O'Neill from BGO. And Josh Gaglardi from Orion Construction. And as always, want to thank this morning's featured sponsors at the platinum level, CBRE, Colliers, GWL Realty Advisors, Hudson Pacific Properties, Low Tide Properties, and Oxford. At the gold level, Farrell Estates, Hungerford Properties, Madison Pacific Properties, Orion Construction, and Turner, and Warrington PCI Management. At the patron level, CDC Construction, CDN Global, Clark Wilson, KPMG, Lee & Associates Commercial Real Estate Services, and Rain City Industrial. And thank you all for joining us this morning. We look forward to seeing you at our next breakfast, which will be held on October 26th. Thanks again.